Hey everyone, thank you so much for joining tonight. It is 7 o'clock, so I'm going to go ahead and get rolling with Equity Compensation 101, everything employees wish someone had told them. Before we get started, my name is Alex Greer. I'm a certified financial planner with Pathfinder Wealth Consulting, and wanted to run through this tonight. I work with a number of clients that have equity compensation as a large part of their compensation at work. And really a big part of their overall financial plans. And it's not uncommon when I start working with somebody and they tell me that they have equity compensation for me to ask if they have, maybe restricted stock units or incentive stock options or an ESOP. And they actually tell me, I don't really know what I have. When I joined my company, I was given the equity comp as a benefit, and I haven't really looked at it. I haven't done any planning with it since then. And so kind of want to run through tonight kind of two different pieces. I do want to talk about the typical types of equity comp that we see. I want to run through some of the most common types, kind of how they function, what they look like, some of the tax treatment and other things to think about. And then I really want to think about and talk about how do we plan for equity comp? How do we use equity comp as part of an overall financial plan? And I think the best way to do that is actually by running through a case study that we've created. So the first half will be a little bit more details about equity comp itself. And then the second half of the presentation is going to be more bigger picture planning focused and how we actually use equity comp in a long-term financial plan. Before we dive in tonight, I do want to mention, for compliance purposes, I am unable to respond to any questions that come in through the webinar chat or through the Q&A feature. Unfortunately, compliance does not like things that they can't track, and they don't have access to our chat here. So we will have a dedicated Q&A session at the end of the webinar. As I'm going through the content tonight, if there are any questions that come up or anything you think of that you would like me to answer specifically, please submit your questions at any time to the following email. That's pwcmarketing@pathfinderwc.com. So again, that's pwcmarketing@pathfinderwc.com. We will have an eye on that email all throughout the webinar. And then at the end of it, I've got some time set aside to run through that Q&A. So why don't we go ahead and dive in? My plan here is to run through the presentation about 20-25 minutes, and then we'll set aside the time for Q&A there, and then I will let everyone get on with their evenings. So before we dive into specifics, just big picture, what is equity compensation? Equity compensation, it's a non-cash payment for services that provides ownership in a company. Typically, people that receive equity comp are executives or key employees that a company wants to retain. We typically see equity comp used from the company side as a retention tool. Now, it comes in many different forms, which we are going to talk about throughout the webinar tonight. For employees, there's a couple of key benefits that come with equity compensation. Number one, it allows employees to directly benefit from company success. So instead of just receiving a salary, maybe just receiving a bonus, you also get to directly benefit from the increase in the company share price, or really the increase in the value of the company over time. This can be a huge benefit that really helps employees build significant wealth. There are also possible advantageous tax treatments for company stock. Every different type of company and equity comp plan has different tax treatment. We're going to run through a number of those different ones tonight. But if we plan ahead of time and we think strategically around the equity comp and how we're going to use it, it's possible for us to come out ahead from a tax side. And really what that means, typically employees that are key employees or executives in a company, it's very, very likely that you are up into higher federal income tax brackets. It's likely that you're pushed up into the 32, 35, maybe even 37% bracket. And so if you receive additional cash bonus, that's going to be taxed at that higher bracket. If we can be strategic around the tax side of equity compensation, we may be able to have a lower effective tax rate on that compensation, which can be really, really advantageous. So before I start running through each type of equity comp individually, I do just want to give an overview of the different types that I'm going to run through tonight. I'm going to talk about restricted stock units, or RSUs. I'm going to talk about employee stock purchase plans. I'm going to talk about incentive stock options and non-qualified stock options, a little bit on ESOPs, and then I am going to talk about stock appreciation rights as well. I would encourage, if you're listening to this webinar and you have a form of equity comp or you don't see exactly what you have listed here, I'd still encourage you to listen to the entire webinar. There's a number of key kind of planning points that really are a through line and stay consistent regardless of what type of equity comp you actually have. Let's go ahead and dive in though and talk about restricted stock units or RSUs. These are currently the most common type of equity compensation that I see. A lot of companies have started to adopt RSUs as their preferred form of equity compensation. And that's due in large part to their relatively simple nature. They can still be confusing, and there is still a lot to know about them. But compared to some of the other forms of equity compensation, RSUs are relatively straightforward. So what an RSU is, it's essentially a promise to give shares of stock at a future date. So when RSUs are granted to an employee, nothing actually happens at that point. There's no tax impact. You don't own the shares. Really, at that point, once they've been granted to you, the company has just promised that at a future time, they are going to give you a certain amount of shares. And so typically what we see is we see a vesting schedule with these. A very, very common one is to have a 3 or 4 year schedule. A lot of times they will just vest once a year. There are some companies that have multiple vesting periods throughout a year, but it's pretty common to see, a 3 year vesting period. And so what you may see is 99 shares granted to an employee with 33 of those shares vesting each year for the next 3 years. The big thing to know about RSUs is that once they vest, they immediately have value and you own the shares. So you don't have to exercise them once they vest. You don't have to purchase them. There's nothing on your end that you have to do with the RSUs. They are just in an account in your name and you have access to them. The other key thing to know is that when they vest, you pay ordinary income tax on the amount that vested. And so with that, it's really, really important to think about and make sure that you're lining that up from a tax planning perspective. Our big goal from a planning side when someone has RSUs is that they won't have a tax surprise come the spring. And so once that is granted to them, making sure that if selling to cover is an option, that the employee does that, or making sure that they just have enough cash on hand to pay that tax bill in the spring. Once it has vested and you pay ordinary income tax in that year, at that point, you are subject to capital gains tax moving forward. So if the shares continue to go up in value and you sell them down the road, you are going to pay a tax on the gain or the increase. That can either be at short-term rates or long-term capital gains rates. And so a key planning point with RSUs, and something I always like to mention to people, is once the shares are vested, you've already paid taxes on those. If you have short-term goals for that money, or you have things that you think that money could fund, it probably makes sense to go ahead and sell as they vest, because then you eliminate the possibility of having to pay additional tax on the shares. It's also good to think about from a concentration standpoint. That's something we're going to talk about in our case study, but it is important to monitor, how much exposure you have to one company. And so if you're trying to diversify out and make sure that your company stock is not too large of a portion of your overall portfolio, it probably makes sense to strategically sell as RSUs vest. So that's how RSUs work and a little bit about RSUs. Next, I want to move and talk about employee stock purchase plans. These are also very, very common. They do work a lot differently from some other forms of equity compensation though. ESPPs, that allows employees to purchase company stock, and typically you get to purchase it at a 5 to 15% discount. The most common discount is 15%. To be honest with you, the clients that I work with, I think almost all of them have a 15% discount on their ESPPs. And this is normally purchased through after-tax payroll deductions, so it can feel similar to a 401k contribution. If you're enrolled in an ESPP, you'll see it on your pay stub. You'll see that actual dollar amount that you're purchasing each pay period reflected on the pay stub. And so the big benefit here you can see immediately is if you have a discount, you're able to purchase shares for less than what they're currently worth. So just a quick example, if your company is currently trading at $100 a share and you're enrolled in an ESPP and you have a 15% discount, you're immediately purchasing shares at $85 and you have a $15 profit, so to speak, or gain already built in regardless of what the stock does, there's no price movement there. Some plans also offer what's called a look back, which can really increase the discount when the price is appreciating. And so the way ESPPs work, to get very, very technical, they have what's called an offering period. Typically, an offering period is going to be, either a 6-month, 12-month, maybe 18-month period. And that's the period with which you're actually buying shares. When you're enrolled in an ESPP and you're making the payroll deduction and the money's going in, typically that money is going into a holding account. It's not actually buying shares each and every pay period. And so what ends up happening is there's the offering date when the ESPP starts, and then there's the purchase date where the shares are actually purchased, typically at some set interval within that offering. And so let's just say hypothetically on the offering date, the shares are trading at $100 a share, and you've got a 15% discount, and so you have the ability to purchase at $85 a share. Well, if the purchase date is not actually until 6 months down the road, and the share at that point is actually worth $150, if you have a look back, instead of purchasing the shares at $150 a share with a 15% discount, you get to purchase at the price on the offering date. So you make the purchase on the $100 share price, and you still get your 15% discount. So what ends up happening is you purchase shares for $85 a share, and they're currently worth $150 a share. So you have a large delta there. It can be really, really advantageous when the price is appreciating to have that look back feature. I will say with the SPPs, there's pretty complex tax rules. I'm not going to get too in the weeds tonight. The big thing to know is that there are two types of dispositions, or there's two types of sales. There's a qualifying disposition and a disqualifying disposition. So a qualifying disposition, it just means that you meet certain holding period rules for the shares that you own. So typically in a qualifying disposition, you're going to hold the shares at least 1 year after the purchase date and at least 2 years after the offering date. If you hold the stock for that amount of time, you're not going to pay any income tax on your discount or the difference in the two. What you're going to do is you're just going to pay long-term capital gains rate on the movement of the stock itself. Now, if it's a disqualifying disposition, that just means that you didn't hold the stock for that period of time. And so what that generally means is that not only are you going to have capital gains tax, but you're also going to have to worry about or think about the ordinary income tax. Now, people a lot of times will ask, well, do I need to always make sure it's a qualifying disposition? Not necessarily. That's really dependent on personal circumstance. If we go back to our example earlier, if you've had really, really big price appreciation, it may make sense to go ahead and sell and pay the extra tax and go ahead and lock in that really, really good return that you've seen on the stock return. So that's ESPPs. Again, we see a lot of people that have those. The next form that I'm going to talk about are stock options. And so this is kind of what I think a lot of people think about when they think about equity comp. There's two types of stock options. There are incentive stock options and non-qualified stock options. There's a few key differences between the two, but they function very, very similarly. So incentive stock options, or ISOs, those are only able to be offered to employees. So it can't be anybody but an employee. And it allows employees to purchase stock at a set strike price. These do receive favorable tax treatment. Again, they have qualifying and disqualifying dispositions. And these are especially popular with startups and fast-growing companies. Again, that's because these are going to allow you to purchase at a set price. And if you see a lot of price appreciation, they can be very, very valuable. The greater the price goes, the greater the benefit. And so when these are granted to you, you are basically given the option at a future date to purchase shares at a certain cost. So let's just say that right now, your company stock is trading at $100 a share, and they give you the option, after a vesting period, to purchase shares for $110 a share. So if we get out to the vesting period and the stock price hasn't moved, there's no value here. You can't exercise them. You would just go and buy the stock on the marketplace. There'd be no reason to use your ISO. However, if over that vesting period, the stock price had moved from $100 to $150, well, you would be able to purchase for $110 and then again have that immediate $40 delta or $40 profit. One thing to note on these is, you do have to be able to purchase the shares, but there are options, things like cashless exercises that brokerages can facilitate, which actually allow you to purchase the shares without putting the cash up. So that's another key thing to check into and make sure with your employer if you have the option to do a cashless exercise. The other note here on incentive stock options is it's really, really important to think about the tax side. Again, there are qualifying dispositions where you only have to worry about capital gains. There's disqualifying dispositions where you do have to worry about income tax as well. The other big thing to think about with stock options is that there is something called alternative minimum tax, which is basically a separate tax system that is in place to make sure that high income earners pay at least a minimum percentage of taxes. So if you have a really, really big delta between the strike price and the current share price, it is possible that you trigger AMT, and it's really, really important to know what that looks like in your projections. That's something that we do a lot with clients, is to make sure, hey, are we going to run into AMT? And if we are going to run into AMT, we need to loop in your CPA and make sure that we have the proper withholdings. We're making the proper quarterly payments to make sure there's no surprises come tax season. I do want to talk quickly about non-qualified stock options, or NSOs. They function almost exactly the same as ISOs. The difference, these can be offered to employees. These can also be offered to non-employees. So board members or key consultants for a company, they may have NSOs. The big difference on these is that they are not qualified for any advantageous tax treatment. So there is no holding period where you avoid ordinary income tax. These are going to be, taxes are probably going to be owed at exercise and when shares are sold on the non-qualified stock options. Now, I do want to talk about employee stock ownership plans, or ESOPs. These are a little bit different. And so the types of equity comp that we've talked about so far, these are all things that you can immediately cash out, so to speak, and take that cash and either reinvest it in a more diversified portfolio, or you could take it and use it to purchase something, whatever you might need to do. ESOPs actually work more like a qualified retirement plan. And so it works more similar to like a 401k would be the example. The employer contributes stock for the benefit of employees. That amount of stock that they contribute is typically based on salary or tenure. It is subject to vesting, so it's very, very common to see in an ESOP, a longer vesting period. I've seen some up to 6 to 8 years, from that time period. And really what that does is hopefully locks in key employees for the company, so they want to stay and let their ESOP vest. But at the end of the vesting period, they're typically not actually accessible until retirement or leaving the company. And the big thing is this is a qualified plan, so retirement distribution rules do apply. And so with an ESOP, if you plan to stay with the company until retirement, from a planning perspective, we're likely not going to ever be using an ESOP to fund short-term goals. We are likely going to be using an ESOP as a part of a bigger picture retirement plan. And it's really, really important to look at what the options are. There can be the ability to sell the stock back to the employer, have cash still in the ESOP, and then roll it to an individual retirement account and avoid any taxable distribution or item like that. If you are pre-retirement age, or you're pre-59 and a half, and you leave an employer that has an ESOP, and you have the ability to, if you vest it, you still have the money, it is important to note that retirement distribution rules apply. So you may owe income tax, and you will likely owe a penalty on that distribution as well. So ESOPs can still be very, very valuable tools. They can grow tax deferred, but it's a little bit different in that we're normally using these more long-term versus thinking about them short-term or using them to fund short-term goals. The last type of equity comp that I want to talk about before I shift gears to talking about my case study are stock appreciation rights. And so stock appreciation rights, they work a little bit differently. They provide a bonus based on increases in company stock price over a period of time. These can be received either in cash or stock, technically. In actual use, we almost always see them as a cash bonus paid out. I have actually never come across someone that has a stock appreciation right that pays out in stock. Now, there is no actual exercise price here, so it works different from an ISO like we talked about previously. These are subject to vesting and they have an expiration date, much like an ISO. But really, these have what's called a grant price, which is basically the stock price that the appreciation is based off of. And so that grant price is a baseline that's used to judge how the stock is performing. The value of the award is the excess above that grant price. So once you've gotten through the vesting period and you're in your exercise period, just to give a quick example, if you were granted 500 shares and the grant price was $100 per share, let's say you had a 2-year vest. So after that 2 years, you have the option to actually exercise the SARs. If the stock is then trading at $300 a share, there's a $200 increase in the stock value. So you have 500 shares, you have $200 increase, 500 times 200, that would be a $100,000 bonus paid out to you. When that bonus is paid out, those gains are taxed as ordinary income at the time of exercise. So stock appreciation rights can be another huge benefit to employees, especially when the stock appreciates. I do see stock appreciation rights as one where it's really, really important to keep an eye on and know how your company is trading. These typically, like I say, they have a vesting period, but there is an expiration period. So you have to use them within a certain period of time. And if your company stock has performed very, very well and run up, it may make sense to go ahead and start exercising and taking advantage of that. These are ones where you really have to weigh the risk of holding on to them, and if the performance falls, not being able to exercise the stock appreciation rights. And now that we've spent about 20 minutes talking through the nuts and bolts here of the different types of equity compensation. So I want to shift gears and talk about the importance of planning. And when I think about planning with equity comp, there are kind of three key things that come to mind for me: the timing, the tax, and then also the concentration, right? So the timing, when are these shares available to you? If you have RSUs, they're probably available to you very, very soon. If you have an ESOP, it's probably not coming to you anytime soon. From a tax perspective, I hate tax surprises personally. My goal is for a client to never have a tax surprise. So we want to think very, very intentionally about when things are going to be exercised and what that tax impact is going to be. And then the last piece is concentration. So, thinking about an overall investment portfolio, how much of your portfolio do you want to have invested in one company? And this is different for different people. I'm going to talk about it in the case study a little bit, but generally it's not uncommon. I've had people come to me before that are maybe a little bit later in their career, in their late 50s, early 60s. And when we actually sit down and look at what they have in their company stock through their equity comp, what they have in their 401k, and maybe what they have in a brokerage account, they may have 50+% of their overall investment portfolio in one company. And not only is that company a huge part of their investment portfolio, that company is also where they receive their income. It's probably where they have their health insurance through. They may have life insurance through the company. So they have a lot riding on the success of their company. So it's really, really important to keep that in mind and think long term and think hard about, how much do I want to hold of my company stock from an overall risk perspective. So I talked about, talking about a case study here. And so we are going to talk about Sarah. Sarah's 38. She's a software engineer in Durham. And so Sarah came to us, and I can promise Sarah is not an actual client. We would never disclose information like that. So just want to throw that out there for everybody on the call. But Sarah came to us and recently received a promotion. And really the reason that Sarah reached out to us is her promotion included RSUs for the first time. And she was really, really uncertain about the tax implications and ultimately how should she balance the long-term growth potential versus funding short-term goals. Sarah was really, really concerned about actually taking that money and using it on something because she didn't want to jeopardize her long-term plans. And so when someone comes to us with those questions, or when Sarah comes to us with those questions, our first step is going to be to actually define what are Sarah's goals, right? And so we're going to have a meeting to sit down and talk through that. And ultimately what we uncovered in our meeting with Sarah is that before anything else, she wants to make sure that she doesn't jeopardize her long-term retirement plans. She wants to make sure that she's doing the right things to be able to retire. But she does want to purchase a second home and purchase a mountain property. And she would ideally like to do that within the next 5 years. And right now, she doesn't have any money set aside for a down payment on that mountain property. And so as we go through, there's probably other goals as well. But for Sarah, we determined that those are the two main items. She really wants to make sure, one, that she doesn't jeopardize retirement, and two, that she can actually make a down payment on a mountain home in the future. And so from there, we're going to start analyzing the best way to accomplish this. And so first, we're going to look big picture. We're going to build out a long-term plan, and we're going to model out what retirement actually looks like. And that way, we can know how much Sarah needs to save towards that retirement. That's going to help us answer the question, big picture, can you afford to buy a second home, or do you need to focus on retirement savings? Once we've built out that long-term plan for Sarah, the results told us that through the savings that she was doing in her 401k and the savings she was doing to another brokerage account with her bonus, she was going to be okay from a retirement perspective. She did not have to let her equity comp, her RSUs, sit and grow. She didn't have to take that money and immediately reinvest it. She has the ability to spend the money. For me, I think this is one of the big benefits of a long-term plan is the ability to know that you can spend that money and not have guilt or not worry that you're jeopardizing your long-term plans. And so once we know that she can use that money for a down payment, well, then we have to look through the timing. So we look at the vesting schedule. If we want to purchase the mountain home within 5 years, in Sarah's case, she had 4 tranches that vested over a 4-year period. So that lined up really, really nicely. We're going to specifically use each tranche to fund that down payment. And so then we looked at the tax impact. So since we knew that we wanted to use this money to fund a short-term goal, and Sarah did not want to have the risk of her company stock price falling over that 4-year period and losing value and making it harder to purchase the home, we decided that as each tranche or each group vested, we were going to immediately sell. We're going to pay the ordinary income tax, but we're not going to have to worry about any potential capital gains or losses. We're just going to sell right away. And then we're going to take those proceeds, and we took those proceeds and reinvested them in a very, very conservative portfolio designed to provide some growth, but ultimately be there in 4 years for a down payment. And so then we have a very clear-cut, mapped out strategy for the next 4 years for her equity comp. The other thing that we're going to do is we are going to go ahead and set some parameters around, once we have funded that short-term goal, if you continue to receive equity comp, how much do you want to hold in your company as a percentage of your overall portfolio? I like to do this at the very beginning of the planning process. And the reason is that if we do it at the beginning, we can make a decision that's not based on emotion. It's not based on recent volatility or recent movement in the stock price. We can have a plan and then make adjustments off of that. Once we make a plan, we can always make adjustments if we need to. But if the stock price starts to move up or down, or it starts to get unpredictable, it's a lot easier to say, hey, let's stick to our plan and stick to what we said we were going to do, versus trying to make a plan at that point when you're dealing with the emotions around your company maybe not doing so well. And so looking at this case study, again, just to kind of reiterate how we work with Sarah, and in this example, how we used equity comp as a part of a bigger financial plan. We reviewed the vesting schedules and tax implication. We reviewed the overall portfolio and set a framework for how much company stock to keep versus sell. We established an investment plan for sold RSU proceeds to directly fund a down payment. And then also, we put all these goals in the context of Sarah's long-term plan to ensure that all of those pieces fit together. We say it all the time with clients that we work with. A financial plan is not a one-time document, but just because we put this plan in place, things can change, and things may change for Sarah that cause us to alter course. But I find that clients find a lot of peace and a lot of value in knowing that they have a very specific plan around their RSUs, and that they're not just sitting there as a company benefit that they haven't thought about, that they haven't touched. And so that is the full presentation for tonight. I did want to open this up for questions, and I'm looking here from Tracy. It does look like we have had a couple questions come through. The first one here, I can go ahead and run through. How much of my net worth should be in company stock? That's a great question. We kind of talked about it a little bit in the case study. It does depend for every single person. So not to give the cliche answer of it depends, but it really, really does. For someone that is more risk averse, you probably don't want to have more than 10% of your overall portfolio held in your company. If you're someone that's near retirement, in your 50s or 60s, getting closer and closer, it's probably another situation where you don't want to have a very, very large portion of your overall investable assets tied up in one company. I will say, if you're younger and you've been granted equity compensation and you want to roll the dice and you want to maybe hold on to it in the hopes that your company sees great increases in value, we can build that out in a plan, and sometimes that makes a lot of sense. I do have clients that are in their early 30s with equity comp that on a percentage basis hold more in their company than I would recommend for a near retiree. It really does depend on your individual situation, to set that number. And that's why we set that as a part of the initial planning process. Other question here, are there ways to mitigate ordinary income tax in years where large grants vest? And that's a really, really good question. I talked about it throughout. You heard a lot that there is ordinary income tax paid a lot of times, especially if we have a disqualifying disposition. And so what can we do about income taxes in those years? From an employee side of things, the first things that we'll look at is, are we maxing the 401k on the pre-tax side? That's going to reduce our taxable income. If you're enrolled in a high deductible health plan, You have access probably to a health savings account. If you do, we want to make sure we max that. That's also going to reduce taxable income. Going back to the 401k, if you're above age 50 and you have access to catch-up contributions, it makes a lot of sense to make sure that you're making that full catch-up contribution as well. And then outside of just some of those, easier, making sure that you're taking advantage of your tax advantaged accounts, there can be other strategies as well. Not to get too in the weeds or too off track here, but one we see with clients who are charitably inclined, it may make sense to use what's called a donor advised fund. A donor advised fund, that's an account type where when you make a contribution to the account, you get the tax deduction for making the charitable contribution, but the money stays in the account and then you can gift from that account in future years. When you make the gift, there's no deduction, but you do receive the deduction in the year that you make the gift. So if someone is already charitably inclined and they know that they plan on giving over the next 10, 15, 20 years, and they're going to have a 2 or 3 year period with very, very high income, it probably would make sense to look at front loading and making really, really large contributions to the donor advised fund to help reduce taxable income in those years, and then using that donor advised funds to make gifts out into the future. That's a pretty nuanced strategy. It's something we would definitely have to talk through individually to see if it made sense for you, but that can be one way to help reduce taxable income on the W-2 side. I am looking here from Tracy. It doesn't look like I've got any other questions that have come through. So with that is Equity Compensation 101. Thank you all for joining. I really, really appreciate you taking the time out of your night. My name again is Alex Greer. I'm a certified financial planner with Pathfinder Wealth Consulting. If you have any questions on your specific situation, please feel free to email me. My email is alex@pathfinderwc.com. Our office phone number is listed there as well. You're more than welcome to give us a call. I will say for all attendees, we will be sending out a post-webinar survey. So please fill that out if you have the time. We'd love to get some feedback on what we covered. Also, we give the option in there for future topics. So I am looking to do more webinars throughout the rest of this year. There's a lot of questions that I get asked pretty frequently, and so I'd like to really, really hit those key topics. But if there's something that's top of mind for you or something you'd like to learn more about, or just something that you get asked about a lot from friends or coworkers, let me know and I can maybe see about putting on a future webinar. So with that is the webinar for tonight. Again, thank you so much for attending, and I hope you have a great rest of the evening.